So we have an important warning about Palantir. Now look, Palantir is currently at $25 per share, and everybody's trying to figure out when the correction is going to happen. We're up 173% over the past year, up 50% over the past month, and everybody's trying to figure out when to jump off this before it goes south, before it corrects back. Now, there's a lot of PTSD because of the way Palantir behaved in the past, and I get it. But I don't think that's the right approach, especially given what happened over the past few weeks. One of the most interesting things about Palantir is what happened in the last couple of weeks, and it completely went under the radar. You have to understand that one of the biggest knocks on this company was, except the part of the dilution and the part about the profitability, these two things have died down. You haven't heard anybody talk about dilution or lack of profitability over the past 2 years because Palantir basically got better. They got complaints. They did not get bitter. They got better. But still, one complaint remains for Palantir, and it's mainly coming from more professional grade investors, which is that the institutional level is not high enough. Not enough professionals, not enough institutional shareholders are holding Palantir. Now, last time we did this video about Palantir, we had about 35% of institutional shareholding in Palantir. And that's quite low compared to the AMDs, the NVIDIAs, the big companies, the blue chips. Now, there are documentation of companies that have done well without having high institutional shareholding. Tesla is one example. But for the most part, the gold standard is if you want to have a company that's sustainable, that's stable, that the share price doesn't go up and down like crazy, you're probably looking for about 60-65% ownership by institutional investors. Now, with Palantir, that was always an issue. But what happened over the past couple of weeks is that the shareholding by institutional investors actually went up from about 35% all the way to 42%. And while that in itself is extremely impressive, no doubt, but the speed at which institutional shareholding is piling into the stock right now is absolutely mind-blowing. I don't think I've seen anything like this before, where so many institutional investors are buying a stock like that. It's almost like a frenzy. Now, a lot of it has to do with the fact that they're prepping for the S&P 500 inclusion. A lot of them have been dying to get into the stock, but they couldn't because of regulatory constraints. There's a lot of reasons, but if you look at this shareholding structure for the company by institutional shareholders from Stock MVP, which shows you what happened, what the trend line looks like, you can see that institutional shareholders were buying the stock and increasing the positions over the past few quarters. And if you had Stock MVP, you could have seen it coming. Stock-mvp.com. Link below, 7 days free trial. Whether the stock goes up and down, whether it corrects or not, I don't know. I don't have a crystal ball, although I did predict SMCI doing 1,000% of the past year. I made a video 8 months ago saying, hey, SMCI is going to go ballistic. I think it was $220 when I made that video. It's currently at 1,000. I'm going to link the video below. Go check it out. But nevertheless, I'm not a prophet and I don't know. But here's the thing. Even though I expect some sort of a correction, some sort of a pullback for the stock because, it went up like crazy, I'm not going to personally sell a single share. And let me explain why. It's not because I have a religious belief in this company. It's not because I think that Alex Karp will be insulted if I do so. And it's not because I don't want to be like certain other YouTubers who have sold too early. Wink, wink. There's a more kind of deep-rooted business reason why I don't want to sell any stock, even though I expect a correction. And here's why. Once you start getting in this game of trying to time the market, right? Once you start in this game of, okay, the stock is at 25. I think it's going to correct to 23, 22, 21. I'm going to sell now. I'm going to repurchase at 21. So essentially, you have two events of timing the market. You have to be right on getting out on time at the top, and you have to be right on getting in the bottom. And hitting two consecutive time the market events for any investor is very, very hard. Certain people can do it. Certain professionals that do it for a living, that obsess about this and they do it on a daily basis, they can do it on a consistent basis. But if you're not a pro who's trading for a living, it's going to be very hard to do. And also there's a lot of stress involved. For me to try and play this game of timing the market twice just to earn a few more pennies, why do I need this stress? Why do I need to worry about this? Check my app, see the price. Why? It just adds extra layers of crap I don't need in my life. I have a limited amount of fucks to give, and I don't want to waste them on a share price. Especially when I look at this company, I say, well, look, This is at least a Salesforce, at least, right? Salesforce makes the gold standard, and CRMs, software, B2B. So at the very least, Palantir is a Salesforce, or a Salesforce equivalent, right? So Salesforce is a $200 billion company. Palantir is currently trading at $50 billion company. So at the very least, the floor for this company is another 4x from here. So I know this is at least a $100 stock, at the very least. I personally think it's a $500 stock. So if I think that this stock is worth between $100 and $500 in 5 to 10 years, why in the world would I even care about reducing my cost base from 25 to 22 and trying to time the market and worrying about this and obsessing about this? Why? Instead, I'm just going to do whatever it is I've done for the past 3 or 4 years, which is just dollar cost average constantly into the stock and not worry about the share price. Now, there's definitely risks with the stock. And it seems like a correction is due. I'm not going to sit here and lie like this stock isn't going to correct. At some point, it's going to correct for sure. But look at it this way. Q4 earnings decimated bears, decimated people who have came out and said, hey, we're sorry, we got Palantir wrong. Plenty of videos like that, the mea culpa videos. 70% commercial growth, 44% of customer growth year over year, up to 375 from 260. 37 deals of 5 million or more, 21 deals of 10 million or more. So a year ago, the top 20 clients of the company were paying on average $49 million per year. It went up to 55 million per year in one single calendar year. Look at the gross margins. 84% gross margin, 50%, almost 50% free cash flow margin. Customer billings increased by 56%. So you look at this company, and sure, you only see 20% revenue growth, but look at the amount of AIPs, the amount of demos. Those are the sales funnels of the company, and they're increasing by 500% a year. It's going to take them another 9 months to go through the sales funnel and actually reflect in the revenues. Why not? It's going to keep the share price cheap enough for me to get more. But I'm not worried about it because it's going to allow me to stay in this current share price and buy more of it before it spikes up. Now, one of the bigger risks for Palantir here is also kind of a non-risk for me. Yes, they're dealing in the most hyper-competitive market of all time. US, software, corporate. These three words mean hell. It means a jungle. It means Hunger Games. But nevertheless, right now, it's their market to grab. It's theirs, and it's probably Microsoft's. So we're looking at the creation of a new dominant market. It's very similar to the cloud business back in the day when you had Amazon step in, and then you had Google and Microsoft and all these other players who came in. Right now, it's the same market that's happening with AIP. So sure, they're probably going to have to split the market with Microsoft, like anybody who does any sort of software. But even if it's a two-headed monster, three-headed monster, we're talking about the new gold standard in a new industry in which they're going to be one of two or one of three. I like that, especially at $50 billion. Just like Tesla, people now will tell you, look, we love the company, we love the business model, we hate the price. We hate that price. Now, since February 2020, not the IPO, since February 2020, Tesla has done 4 times on the money for their investors. 4x on their money since February 2020. Not even talking about the thousands of percents from the IPO. So as far as Tesla investors go, I don't think any of them regrets buying expensive stock because look at what it's done for the past few years. And the same thing will happen with Palantir at a greater scale, obviously, because they're way, way earlier in their life cycle. And the same people will complain that the share price is just too expensive. The PE is too high. The revenues are not enough. And that's fine. This stock is not for everyone. In fact, it's for the very few that actually get it. If you're part of that group, shout out to you. Much love. I'll see you in the next one. Go Palantir. Now, if you want to learn more about how to become a better long-term investor, I invite you to join our free Discord, discord.gg/Tom Nash. We would love to see you there. Talk to us about your stocks, about your dilemmas. It's kind of a support group for all our community members. We would love to see you there. Obviously, you want to take the next step. Consider joining our Patreon, patreon.com/Tom Nash. And if you want to analyze stocks for yourself better, consider using Stock MVP. You get a 1-week free trial on Stock MVP, stock-mvp.com. It's a tool we built for you guys. Would love for you to try it out. Thank you so much. Don't panic. Keep your eye on the ball. Go Palantir. I'll see you in the next one.